All right, let's jump right in. We're tackling a question I've been getting a ton lately.
Oh, yeah.
Yeah. How can U.S. companies actually use the UAE's, tax breaks?
Yeah,
Everyone's talking about it.
right.
But I'm getting the feeling it's a lot more complicated than people think.
It is.
So luckily, I've got an expert here to break it all down.
Happy to be here.
We've got some research lined up.
Okay.
So big questions today. What are the real benefits, tax-wise in the UAE?
Hmm.
And how do those even matter when you've got the IRS waiting back home?
Yeah.
Then how do you even set up over there? What are the different options? And which one actually makes sense for you?
Right.
And are there any, big companies already doing this well that we can, learn from?
Yeah, absolutely. It's a hot topic, and for
Hmm.
good reason. I mean, the UAE, especially those free zones, they've got that reputation,
Oh, totally.
almost like a tax haven, right?
Right. But it can't be as simple as just, showing up and pocketing all your profits,
Correct.
right?
Yeah. No, it's not quite that simple.
Okay. Yeah.
It's tempting to think of the UAE, especially the free zones,
Mhm.
as like these tax-free wonderlands where companies like Amazon and Tesla just,
Yeah,
just rake it in, no worries.
right.
But while there's some truth to that,
Yeah.
the reality is, well, more complicated.
Okay, so let's get into it.
Yeah.
What's the real appeal tax-wise, for U.S. companies looking at the UAE?
Yeah, it boils down to the UAE's historically low tax rates,
Okay.
particularly their, famous 0% corporate tax on eligible activities outside the UAE mainland.
Got it.
And you read about Amazon and Tesla.
Hmm.
They've definitely used these free zones strategically to lower their tax burden.
Wow, that's incredible.
Yeah,
But didn't the UAE recently start a new corporate tax?
they did. Yeah.
Did that change everything?
It shook things up a bit, for sure.
Wow.
It was back in June 2023.
Mhm.
They put in a 9% corporate tax on any profits over AED 375,000, which comes out to about 102,000 US dollars.
So is that 0%? Is that gone now?
Not necessarily.
Wow.
Here's where those free zones get really interesting.
Okay.
Places like the Dubai Multi-Commodity Center
Hmm.
or DMCC, they can still offer that 0% rate, depending on the company and what they do.
Okay, that's a little confusing.
Yeah,
But let's back up for a sec. We're talking about U.S. companies here.
right.
And the IRS, they want their share, right? Doesn't matter where you earn the money.
Exactly.
So isn't there a risk of getting hit with double taxation?
That's the big question.
Yeah.
That potential for double taxation, that's a major concern for any U.S. company really looking to expand internationally.
Yeah.
But this is where the U.S. tax code actually gets strategic.
Okay.
The U.S. has this thing called the Foreign Tax Credit, or FTC,
Okay.
and it's specifically designed to avoid that double whammy.
So wait, even though you're paying taxes in the UAE, you can use that to reduce what you owe the IRS.
Exactly.
Wow.
Think of it like you're getting credit for those taxes you've already paid to another country.
Okay. I'm starting to see how this could work.
Yeah.
Can you give me an example? How does a company like Procter & Gamble use this FTC with their stuff in the UAE?
Procter & Gamble is a great example because they have subsidiaries all over the place,
Right.
including the UAE.
Yeah.
So let's say their UAE subsidiary makes a profit,
Mm-hmm.
pays taxes on that income to the UAE government.
Okay.
When P&G files its U.S. taxes, they can claim a credit for those UAE taxes,
Mm-hmm.
directly reducing their U.S. tax bill.
That's pretty clever.
It's not about avoiding taxes.
Right.
It's about managing, your global tax burden.
Smart. So, okay, let's say I'm sold.
Okay.
I want to set up in the UAE. What are my options? How do I actually do it?
Well, there are three main paths.
Okay.
You could set up a UAE subsidiary. You could establish an independent UAE entity. Or you could, focus your operations in a specific free zone.
Okay.
Each one has its own quirks,
Yeah.
especially when it comes to how the IRS is going to view your setup.
All right, so let's break these down.
Right.
First, the UAE subsidiary. What's that all about?
A subsidiary is kind of like a child company,
Yep.
wholly owned by the parent company back in the U.S.
Got it.
It's pretty common.
Yeah.
Companies like Apple do it all the time.
Right.
They've got subsidiaries worldwide.
Okay.
So basically, your U.S. entity sets up this daughter company in the UAE.
Mm-hmm.
The subsidiary, it pays taxes in the UAE on its UAE earnings,
Okay.
but any dividends paid back to that U.S. parent, those are still going to be subject to U.S. taxes.
So there's still a chance of U.S. taxes there.
Right.
What about setting up an independent UAE entity?
Yeah.
How's that different?
This is where things get a little more independent,
Okay.
potentially a bit more complex. Instead of a subsidiary, you're creating a whole separate UAE company.
Right.
Totally distinct from your U.S. operations.
Interesting.
Like, imagine a tech entrepreneur starting their company in, say, the KZ free zone. Now, this approach, if it's done right, can really limit your U.S. tax exposure because the profits stay within that UAE entity.
Got it.
But there's a catch.
Oh, boy.
The IRS has these rules, right?
Yeah.
To stop companies from just shifting profits to tax havens.
Makes sense.
Just to avoid paying U.S. taxes.
Right. Yeah.
These are the Controlled Foreign Corporation rules, or CFC rules.
Okay, CFC rules, those sound a little scary.
Yeah.
We'll have to come back to those.
For sure.
But first, let's talk about that third option.
Okay.
Operating within a free zone.
Right.
How does that work?
Free zones are like designated areas. They've got their own special tax benefits and regulations.
Okay.
And they're designed to attract foreign investment.
Got it.
Like little economic ecosystems within the UAE. Interesting.
So companies like Tesla, for example,
Yeah.
they strategically put their regional operations in Dubai free zones. And that way, they can take advantage of those tax benefits on the income generated outside the UAE mainland.
Okay, so free zones sound pretty attractive.
They are.
But what are the downsides? Like, what should people watch out for?
Right. Well, every rose has its thorns, right?
Of course.
So while those tax advantages are, tempting,
Yeah.
there are a few potential pitfalls.
Okay.
One of the biggest ones is the risk of double taxation.
Wait, hold on.
Yeah.
You said the FTC protects against that.
Yeah.
So how is that possible?
So the UAE, they don't impose withholding taxes on dividends or interest or royalties paid to foreign entities.
Right.
That means, your money can go back to the U.S. without being taxed at the source.
Okay, so what's the problem?
The problem is that when those profits hit the U.S., the IRS, they're probably going to want their cut.
Even though you paid taxes in the UAE, you got to think about your U.S. tax obligations, too.
So the FTC doesn't always completely get rid of double taxation.
It can significantly reduce it,
Okay.
but it might not totally eliminate it.
Got
It really depends on the specifics of, how you're operating.
Okay, so double taxation is one thing.
Love those CFC rules we mentioned earlier.
Oh, right, yeah.
Those are a major consideration. They can get pretty complex. But basically, if the IRS decides that your UAE entity is a CFC, then any passive income, it generates things like dividends, royalties, interest.
Right.
That could be taxed immediately in the U.S.
Oh, wow.
It's a trap a lot of companies fall into.
Okay, so can you give me an example? Like, how could that happen?
Sure. Let's say a U.S. company owns 60% of a UAE subsidiary.
Okay.
And that subsidiary, all it does is hold investments or generate royalties.
Yeah.
That's passive income,
Right.
not active business income. That could trigger those CFC rules, and then you get hit with those U.S. tax bills you weren't expecting.
Yikes, a tax trap.
Yeah.
Okay, anything else? Like, what other red flags should I be looking out for?
Another big one is transfer pricing.
Okay.
Basically, any transactions between your U.S. and UAE entities, whether it's selling goods, services, intellectual property, it all has to be done at arm's length.
Arm's length. Ouch, what does that even mean?
Haha, no.
Okay.
It just means the pricing has to reflect what two unrelated companies would charge each other.
Okay.
In a similar deal.
So you can't just make up prices to move profits around.
Right, exactly. It prevents companies from artificially inflating or deflating prices just to shift profits around and, avoid taxes.
Got it.
So Google, for example, they're very careful about documenting their intercompany charges for things like, using intellectual property just to make sure everything's above board and compliant with those transfer pricing rules.
So it's like proving to the IRS that you're playing fair.
Right.
Even within your own company.
Yeah.
Okay, this is all really helpful, but my head's spinning a little bit.
It's a lot.
We've talked about a lot of potential issues.
Yeah.
Are there any, proven strategies for U.S. companies to actually minimize their U.S. tax liability when they're operating in the UAE?
Absolutely.
Okay, good.
We talked about the foreign tax credit.
Right.
That's a big one.
Okay.
It's a powerful tool.
Okay.
But let's break it down a little further.
Yeah.
Imagine you have a U.S. trading company.
Okay.
And they're operating in, let's say, the DMCC free zone. They're paying that 9% corporate tax on any profits over that over that AED 375,000.
Right.
So when they bring those profits back to the U.S.,
Yeah.
they can claim a credit for the taxes they've already paid in the UAE.
Okay.
It can significantly reduce their overall tax burden.
So the FTC is like a shield against the IRS double dipping.
Exactly.
Okay, what else? What other strategies can U.S. entities use?
One that's often overlooked is establishing substance,
Okay.
like a real, genuine economic presence in the UAE.
Right.
It's not enough to just have a name on a door.
Yeah.
You got to show that you're actually operating there.
Okay.
You're making decisions locally,
Right.
engaging in activities that are actually contributing to the UAE economy.
So it's not just about minimizing taxes.
Right.
It's about being a real part of the UAE business world.
Exactly. Companies like PepsiCo, they're a good example.
Mm-hmm.
They have a big presence in Dubai.
Yeah.
Local employees, offices, a whole management team making decisions there on the ground.
Right.
That level of commitment
Yeah.
shows that you're not just there for the tax break.
Mm-hmm.
You're a genuine contributor to the UAE economy.
Okay. Makes sense.
Yeah.
So assuming I'm ready to go for it,
Yep.
how do I choose the right free zone? There's so many of them.
There are a lot, yeah.
It's overwhelming.
The UAE has over 40 free zones.
Wow.
Each with their own specialties and advantages.
Right.
It can definitely feel overwhelming.
Yeah.
So to make it a little easier, maybe we can highlight 3 of the most popular ones
Okay.
to give you an idea.
Perfect.
Uh,
We've talked a lot about DMCC.
Right.
So let's start there.
Okay.
What makes it so special?
Well, the DMCC, it's a global powerhouse.
Okay.
It's attracted over 21,000 companies,
Wow.
including, giants like Google and Amazon.
Yeah.
It's a major hub for trading, e-commerce, professional services.
Mm-hmm.
And remember that 0% corporate tax rate we talked about.
Yeah.
The DMCC offers that to eligible companies.
Wow.
Makes it incredibly attractive for
Wow.
U.S. entities looking for that tax efficiency.
So if you're in trading or e-commerce, DMCC is the place to be.
It's a good option, yeah.
What about tech companies? Where do they go?
Dubai Internet City, or DIC.
Okay.
That's their haven.
Okay.
It's a tech-focused free zone,
Got it.
and it's home to big names.
Yeah.
Microsoft, Oracle.
Right.
They offer access to incredible infrastructure,
Mm-hmm.
a skilled tech workforce,
Yeah.
and a really vibrant environment for innovation.
If you're in tech, that's where you want to be.
Yeah, DIC is definitely worth a look.
And lastly, RecEZ.
Yes.
What's the draw there?
ROKEZ, that's short for Ras Al Khaimah Economic Zone.
Okay.
Known for being very affordable
Okay.
and easy to set up in.
Got it.
It's a popular choice for startups and smaller businesses,
Mm-hmm.
especially in manufacturing, trading, and services.
Okay.
They've got great access to international markets
Yeah.
through their global port connections.
That makes sense.
Yeah, it's a great option for companies looking for a cost-effective way to get into the UAE market.
So this is all incredibly insightful.
Good.
So for our listener who's been taking notes, what are the key things they should keep in mind?
I think the big takeaway is that the UAE offers a lot for U.S. companies,
Right, yeah.
especially those looking to optimize their tax strategy.
Right.
But it's not a one-size-fits-all solution.
Right.
You need to plan carefully.
Okay.
You need to get expert guidance.
Yeah.
And you really need a deep understanding of both U.S. and UAE tax regulations.
Mm-hmm.
The rewards can be substantial.
Yeah.
But you've got to be strategic.
Right.
You got to think it through.
I think that's a great place to pause.
Okay.
We've covered a lot today,
We have.
but there's still so much more to talk about.
Definitely.
So stay tuned for part 2,
Okay.
where we're gonna dig even deeper into specific strategies and compliance considerations
Yeah.
and real world examples of U.S. companies that are doing this successfully in the UAE.
Looking forward to it.
Yeah, me too.
All right.